The single biggest concern I hear from people who want to retire before the age of 65 is, what am I going to do for health insurance? If that's your concern, this is a great video for you. There's a very powerful tax strategy that could help you in a huge way, but it's very often misunderstood. This is called the premium tax credit for healthcare. This is that tax credit that was front and center in the news in 2025 when they were negotiating the new tax package. If you just listen to the headlines in the news, you would think that this tax credit no longer exists. That is not the case. What actually happened was the tax credit rules were rolled back to what they were pre-COVID. This tax credit existed long before COVID. It expanded during COVID, and now it looks like it did before the COVID expansion happened. One of the core tenets to capturing this tax strategy is you have to be eligible for it based on your tax return income in the year that you claim the tax credit. If you're a family of two, your income can be no higher than 400% of the federal poverty guidelines, which is roughly 84,000 and change. Pay close attention to what I said makes you eligible. It's income, not assets. We help many millionaires that have multiple seven figures saved qualify for this tax credit. The whole strategy around being able to get this tax credit is intentionally being able to control what your income looks like on your tax return. Just because your income is at a certain level, it doesn't mean you have to keep your expenses at that level or below. Think about if you had $100,000 in a checking account and you withdrew it all. Does that show up on your tax return? No, it doesn't. You need to pay extra careful attention and know full well when and how income is going to hit your tax return based off when you make changes in your financial planning strategy. It's all the planning strategies that you can do before retirement and after retirement that is going to make this possible. For most people, they're only trying to collect this tax credit from anywhere from 1 to 5 years. So you just need to be able to position yourself to be able to make your required withdrawals to meet your income expenses from places that will not show up and translate into income on your tax return. There's strategies like forward recognizing taxable gains in brokerage accounts, Roth conversion planning, pulling from taxable non-retirement bank accounts and other taxable accounts, potentially taking a loan, a securities-based line of credit, a home equity line of credit, if you need to get income in a way that does not show up on your tax return. Other things you might consider are delaying your Social Security, delaying your pension distribution. It's all about crafting a very tax-sensitive income plan to intentionally keep you below this threshold. One of the things to think about is this threshold is a cliff. If you're $1 above it, with the new rules from 2025, no tax credit for you. But you can bring your income up to a certain level, so we can have some income. We want to be very intentional about how much income we take. When you're looking at this screen, this shows you literally the Access Health Connecticut website. I gave an example here. You can see the inputs on the left-hand side. 2 people, age 62. I set their target income to $50,000. And now I sorted it for gold-based plans. This is really quality health insurance. You can see $193 for this tax credit. And that's after a roughly $1,600 a month per person tax credit. So think that if you're saving potentially $30,000, $35,000 a year in unpaid health insurance premiums, and the compound value of that, if you do that for, say, 5 years, well over $150,000 saved in not having to pay those normal price premiums for health insurance. It's not just about the compounded savings in those 5 years in terms of what you didn't pay for health insurance. It's now the growth on that $150,000 growing in your pocket for 20 or 30 years. This could compound for you maybe $300,000, $400,000, $500,000 to be there in addition to what you would have saved for you at the end of your plan, for you to use in your own life or for you to use for your family and your legacy planning. The federal government, when they were making these tax credit changes in 2025, I feel like they're thinking it's people like Brian that are helping these millionaires qualify for this gold-plated health insurance plan at paying a subsidized price. But we don't make the rules. How you qualify for this tax credit is based on income. It's not based on assets. The distinction of qualifying for this plan on income, not on how much you have saved, not on your asset level, is incredibly important. It's the whole crux of this. You can have seven figures, multiple seven figures, or more saved and still qualify for this tax credit. It's all about how you structure your savings planning in terms of different buckets, knowing full well how they're going to be treated from a tax perspective when you take the money out and use it to fund your lifestyle expenses in these years that you're trying to get the tax credit. After you turn 65, then you go on Medicare and you don't have to stay below that 400% of the poverty level cap anymore. It's important to recognize that 400%, that number is different depending on how big your household size is. Family of 1, 2, 3, 4, all of those numbers are different. You can find those charts online. There's a very specific number that you need to stay below. It's a cliff. $1 above, no tax credit for you. So you can see how important it is that you really have your arms around your retirement income strategy and how it integrates with your tax plan and your investment strategy going into this crucial stage of your life. Let's talk about the benefit that you get from capturing this tax strategy. So many people want to retire early, but they don't do it because they say, I'm going to work for the benefits. If I retire, health insurance is going to cost a fortune. What would it mean to you if you had 3 more years in retirement earlier in the retirement cycle? Those first 3 years of retirement might be the best 3 years of your retirement because you're younger, you have that much more energy, get up and go to do these things that you've been putting off because you just don't have time to do them because you're working so much. It's important to recognize the inputs on this page. This is a family of 2. Their target income is $50,000 on their tax return. Again, that's not their expenses. These people have multiple seven figures saved. This is just what we're going to intentionally bring their taxable income on their tax return to for just a short period of time, anywhere from 1 to 5 years. Look at the Anthem Gold PPO plan. That's $193. That's for a family. That's for 2 people. And you can see just below that, that is the price after a $3,500 a month tax credit. Think how much value that is saved. That means you are not having to pay the full price, which is the $193 plus the $3,500 per month. That's a tax credit. That's money you don't have to pay. Then think about what is the compounded value of saving $3,500 a month. That $3,500 a month that you're not paying to the health insurance company, that you're getting advanced to in a tax credit, that's money that will stay in your savings pot and continue to grow and compound. If you did this for a 5-year period, that means you retired 5 years younger than you wanted to, and you saved somewhere over $150,000 in unpaid health insurance premiums that came back to you in the form of a tax credit. That could compound and grow in your savings pot to be worth maybe more than $500,000 for you at the end of your plan to use for your end of life expenses or just for legacy planning for yourself and your family. I'm sure you could think of other things you'd like to do with that money than pay health insurance costs with it. Most people mistakenly think that this is a tax credit that's only available for people who have limited means. That is not the case. You qualify for this tax credit based on your income, not on your assets. We help people that have multiple seven figures saved all the time get this tax credit. And you only need to keep your income below this certain threshold for a small period of time. Once you get to Medicare age 65, you don't need to keep your income below that 400% poverty level cap anymore. You can go beyond it because at that point you're on Medicare, and Medicare has its own pricing structure, but it's significantly cheaper than what this coverage would cost. One of the biggest retirement bombs out there that I hear all the time is I can't retire until I'm 65 because I don't have health insurance. This is the pathway for you to get to that. Another fear that people have is, Brian, I inputted in your example $50,000 into my income for this tax credit. What happens if I go over that level? As long as you stay below that 400% of the poverty level cap, you're going to get a significant amount of tax credit. You may not get all of that. They may claw a little bit back from you when you file your state tax return, but you're still going to get a lot of this credit. What you really need to pay attention to is not going over that threshold, that 400% of the poverty level cap. If you're $1 over, you no longer get the tax credit. That's what changed in the tax law in 2025. During COVID, that level was expanded. A lot more people were getting the tax credit, even people above and beyond that 400% threshold. During the tax law of 2025 changes, they brought it back to that pure cliff. Now we have to be 100% below that level. We cannot be above it anymore, but you still qualify for the plan based on income, not on assets. I have a practice specifically focused on helping people in this retirement transition stage of their life. This is not a general financial planning strategy. It's why you probably haven't heard about it before, but it's real, and it's really important that you think about this, especially if you're someone who wants to retire before the age of 65, or at least wants to explore if that's even possible. For most people, their biggest fear is they can't do it because health insurance is prohibitively expensive. This is a pathway for you to retire before that age, start living this next chapter to its fullest, and not having to break the bank to pay for health insurance. The integration of retirement-specific tax strategy with financial planning and investments is the crux of what really makes a strong retirement plan as you enter this stage of your life. This is just one of many choices that you need to make as you make this transition from working and saving towards retirement that you've never had to make before, and a lot of them you only have one chance to do it. So you want to make sure you're informed as you're putting this plan together. If you have questions about retirement planning, specifically retirement tax strategy or this tax credit for healthcare strategy, go ahead and go to my website or the link in my bio and schedule a time to talk with me. I'd be happy to walk you through it and see if it might be applicable for your situation. It's all about shaping your pieces in advance to know how you're going to take the money out and qualify for this in advance of retirement and trying to apply for it. If you're trying to do this on the fly, there's a good chance it might not work. If you found this content helpful, you found it informative, awesome. Subscribe to the YouTube channel, connect on LinkedIn. I'm going to be putting out more content just like this. If you have other questions that are a little bit deeper that I wasn't able to dive into in this video, or you have questions about how it pertains to you individually, awesome, totally okay. Go to the link on my website. There's a space where you can book some time with us. I'd be happy to talk to you about it. Help you as much as I can. It's complimentary. I'll point you in the right direction. If you have other questions, we can tackle those too. Thanks so much for joining us. Have a great day.